Wall Street, with its complex jargon and intimidating demeanor, often feels like a world reserved for financial gurus. We see suits striking deals, analysts throwing out predictions, and it's easy to feel like we're on the outside looking in. Peter Lynch, however, flips this notion on its head. He assures us that we, the everyday investors, have an edge over Wall Street giants. Lynch argues that investing doesn't have to be about deciphering cryptic algorithms or mastering technical analysis. Instead, he suggests we look around, observe, and trust our own experiences. That's because, in our daily lives, we often encounter investment opportunities before they hit the radar of Wall Street analysts. This concept forms the crux of Lynch's philosophy. Invest in what you know. It's about recognizing the potential of companies and products that are already part of our lives. Think about it. Who knows a restaurant better than a regular customer? Who can better gauge the appeal of a new clothing line than someone who actually wears those clothes? Lynch believes that this inherent knowledge gives us, the dumb money, a distinct advantage. We can leverage our first-hand experiences, our understanding of consumer trends, and our gut feelings to make informed investment decisions. This doesn't mean blindly trusting your instincts, of course. Lynch emphasizes the importance of research and due diligence. But he reminds us that research begins with what we already know. It's about asking the right questions. Does this product solve a problem I face? Would I recommend this service to a friend? By combining our personal insights with a bit of research, we can cut through the noise and make sense of the market. This approach empowers us to take control of our financial futures and potentially achieve significant returns. Remember, as Peter Lynch famously said, the best investment you can make is in yourself. Imagine this. You're a parent, juggling work and family life, constantly on the lookout for products that make your days a little easier. You stumble upon a new line of baby products at your local supermarket, say organic baby food that's both healthy and convenient. You try it, your baby loves it, and you find yourself recommending it to other parents. This, according to Peter Lynch, is where dumb money gains its edge. You, the consumer, have identified a winning product before it even hits the radar of Wall Street analysts. You've seen firsthand the positive response, the potential for growth. This isn't about insider trading or complex financial models. It's about recognizing opportunity in your everyday life. Lynch argues that these seemingly mundane observations can be incredibly powerful. A teenager excited about a new video game, a fitness enthusiast raving about a revolutionary workout app. These are all potential investment leads waiting to be explored. By paying attention to what resonates with us and those around us, we tap into a wellspring of market insights. The power of knowing what you own extends beyond recognizing popular products. It's about understanding the underlying businesses, their operations, and their potential for growth. Let's say you're a coffee enthusiast, and you've witnessed the meteoric rise of a local coffee chain. You love their coffee, you frequent their stores, and you've noticed their expansion into new neighborhoods. Instead of just being a loyal customer, Lynch encourages you to think like an investor. What makes this coffee chain stand out from the competition? Is it their unique brewing process, their commitment to sustainable sourcing, or their exceptional customer service? Understanding these factors allows you to assess their long-term viability. Would you invest in a restaurant you've never dined at? Probably not. This same logic, Lynch argues, should apply to all investments. Don't be afraid to delve deeper into companies that pique your interest. Read their annual reports, understand their financials, and determine if their business model aligns with your investment goals. Remember, knowledge is power, and in the world of investing, it can also lead to profit. Imagine buying a stock and watching it multiply in value, not just double, but tenfold. That, in Peter Lynch's world, is a tenbagger, a stock that delivers a 1,000% return on your investment. Sounds like a dream, right? Well, Lynch assures us that these opportunities exist, and they're often hiding in plain sight. Think of companies like Apple, Amazon, or even Starbucks in their early days. These were not overnight successes. but companies that steadily grew, innovated, and captured market share, rewarding early investors handsomely along the way. Lynch believes that by identifying these future giants early on, we can position ourselves for extraordinary gains. The key, according to Lynch, is to look for companies with strong growth potential, a competitive edge, and a management team that can execute its vision. These are not always the flashy, headline-grabbing companies, but rather those quietly building solid businesses. Remember, even the mightiest oak tree was once a small sapling. Now you might be thinking, how can I possibly identify these future tenbaggers with my limited time and resources? Peter Lynch has the answer: the 2-minute drill. This isn't about becoming a financial analyst overnight, but rather about developing a quick and efficient way to evaluate a company's potential. Lynch suggests starting with a company's earnings growth. Is it consistently increasing its profits? Next, delve into its debt levels. Is it drowning in debt or managing it responsibly? Look at its cash flow. Is it generating enough cash to fund its operations and growth? These are just a few of the key metrics Lynch recommends focusing on. The beauty of the 2-minute drill is that it provides a framework for quickly assessing a company's financial health and growth prospects without getting bogged down in complex analysis. It's about asking the right questions and looking for red flags. The financial world thrives on noise, a cacophony of expert opinions, market predictions, and breaking news, all vying for your attention. It's easy to get swept up in the frenzy, reacting to every dip and spike in the market. Peter Lynch, however, advises a different approach: tune out the noise. He argues that short-term market fluctuations are often driven by emotion and speculation, not by the underlying fundamentals of companies. Obsessing over daily price movements can lead to impulsive decisions, buying high out of fear of missing out and selling low in a panic. Instead of trying to time the market, Lynch advocates for a long-term perspective. He reminds us that over time, the market tends to go up, reflecting the growth of the economy and the companies within it. By focusing on the fundamentals, earnings growth, market share, innovation, we can ride out the short-term volatility and reap the rewards of long-term investing. Section 2: 6 Paths to Profit. Not all companies are created equal. Some grow at a snail's pace, while others explode onto the scene, taking the market by storm. Peter Lynch, in his quest to simplify investing, categorizes companies into 6 stock categories, each with its own set of characteristics and potential for growth. Slow growers are like reliable old cars. They chug along, providing steady but unspectacular returns. Stalwarts are the blue-chip companies, think Coca-Cola or Johnson & Johnson, offering stability and moderate growth. Fast growers are the exciting newcomers, disrupting industries and generating significant returns, but also carrying higher risk. Cyclicals are companies whose fortunes are tied to economic cycles, like airlines or automakers. Turnarounds are the underdogs, struggling companies with the potential for a comeback. Finally, asset plays are companies sitting on valuable assets like real estate or patents that may be undervalued by the market. Section 1: The Art of Letting Go. We've talked about finding those winning stocks, those potential 10-baggers that get your investor heart racing. But knowing when to hold them and when to fold them is just as crucial. Even the shiniest stocks can lose their luster, and recognizing when to sell is an art Peter Lynch mastered. Remember those fundamentals we discussed? If a company's earnings start to dwindle, its debt skyrockets, or its competitive edge dulls, it might be time to reconsider your position. Think of it like a delicious meal at your favorite restaurant. If the quality dips, the service falters, and the prices rise, you'd probably choose to dine elsewhere. The same principle applies to your portfolio. Don't be afraid to cut your losses and reinvest in companies that better align with your investment goals. Holding on to a stock simply because it's performed well in the past can be a recipe for disaster. Remember, in the stock market, past performance is not necessarily indicative of future results. Section 2: Dividends, the investor's reward. Think of dividends as a little bonus, a token of appreciation from a company for believing in its growth. These regular payouts, often quarterly, are a portion of a company's profits distributed amongst its shareholders. Now, not all companies offer dividends. Some choose to reinvest all their profits back into the business, aiming for greater growth down the line. However, consistent dividend payments can be a reassuring sign of a company's financial health and its commitment to rewarding investors. For long-term investors, dividends can be a source of passive income, a way to participate in a company's success without selling your shares. Think of it as owning a piece of a fruit-bearing tree. You get to enjoy the fruits, dividends, while the tree itself continues to grow. Moreover, reinvesting those dividends can supercharge your returns through the magic of compounding. It's like planting the seeds from the fruits you've earned, leading to even more bountiful harvests in the future. Remember that friend who always chases the latest fad, only to be disappointed when the hype fades away? The stock market has its share of such fleeting trends, often disguised as hot stocks. These are companies that experience a sudden surge in popularity, their stock prices skyrocketing like fireworks on New Year's Eve. Investors, blinded by the allure of quick riches, jump on board, hoping to ride the wave to fortune. But Peter Lynch warns us about the dangers of succumbing to this fear of missing out. Just like those trendy sneakers that lose their appeal after a season, many hot stocks lack the substance to sustain their growth. Their rise is often fueled by speculation, social media buzz, or short-lived market trends, not by sound business fundamentals. As quickly as they ascend, they can plummet, leaving investors who bought at the peak nursing significant losses. Lynch advises us to approach such investments with a healthy dose of skepticism. Remember, a dazzling display doesn't always equate to long-term value. Before you hit that buy button, ask yourself, is this company truly innovative, or is it simply riding a wave of hype? In the world of investing, patience isn't just a virtue, it's your secret weapon. While day traders frantically chase quick profits, Peter Lynch advocates for a different approach: investing for the long haul. He reminds us that building wealth in the stock market is like growing a magnificent oak tree. It takes time, nurturing, and a belief in the power of compounding. Think of it this way: every dollar you invest has the potential to earn more dollars, and those earnings can be reinvested to generate even greater returns. Over time, even small, consistent investments can snowball into a substantial portfolio. This is the magic of compound interest, often described as the eighth wonder of the world. However, this magic requires a crucial ingredient: time. The longer you stay invested in quality companies, the more you benefit from the compounding effect. So resist the urge to constantly tinker with your portfolio or chase the latest market buzz. Instead, focus on identifying companies with strong fundamentals, a track record of growth, and a management team you believe in. Peter Lynch's investment philosophy is a breath of fresh air in a world often shrouded in complexity and exclusivity. He reminds us that we don't need to be Wall Street insiders or financial wizards to succeed in the stock market. We already possess a powerful toolkit, our own experiences, observations, and understanding of the world around us. By tapping into this dumb money advantage, we can level the playing field and even gain an edge over the pros. Lynch encourages us to be curious observers, to pay attention to the products and services that resonate with us and those around us. He challenges us to think like business owners, to understand the companies we invest in, their strengths, weaknesses, and potential for growth. This approach empowers us to make informed investment decisions, not based on fleeting trends or expert opinions, but on our own research, analysis, and understanding of the businesses we believe in. Investing, at its core, is about participating in the growth of companies, and by extension, the economy. It's about allocating your hard-earned money to businesses you believe in, businesses that are solving problems, innovating, and creating value. Peter Lynch's teachings provide a roadmap for navigating this exciting but often intimidating world. He reminds us that Rome wasn't built in a day, and neither are successful investment portfolios. Building wealth takes time, patience, and a disciplined approach. Just as a mason carefully selects and lays each brick, we must carefully choose the companies we invest in, understanding their foundations and their potential for growth. Avoid the temptation to chase quick riches or get swayed by market noise. Instead, focus on the fundamentals: earnings growth, debt levels, cash flow, and invest in companies you understand and believe in for the long haul. Remember, every investment decision is a brick in the edifice of your financial future. By choosing wisely, staying disciplined, and embracing a long-term perspective, you can build a portfolio that stands the test of time, weathering market storms and rewarding you for years to come.